Good morning all, and welcome to today's webinar on financial update for Academy's Summer 2020. I can't believe we're at summer already. It's the 1st of July today. I think we're all waiting for the announcement from our Prime Minister over where we can go on holidays this summer, but I still can't believe it's the 1st of July. My name's Alex Makinson. I'll be taking you through the first part of today's webinar. I have with me today a colleague, Louise Casey, and she'll be taking you through the second part of the webinar. Just some housekeeping to get us started. If you're unable to hear me for some reason, then you can dial in using your mobile phone. The telephone number and access codes are on the screen now. Just make a little note of them because you may need them in the future, just in case you have any audio issues. On to the technology issues. This is a live broadcast. It's a live webinar from a home broadband connection. So fingers crossed it does all go well and we don't have any technology issues. You're more than welcome to ask any questions throughout the webinar. There's a chat box and function within GoToWebinar where you can slot in your questions and only we get to see them as such. However, we'll probably leave the questions until the very end and we'll probably run out of time and we'll only be able to answer one or two of them, but we will come back to you with answers to all of your questions after the webinar if we can't answer them at the end. I have put on the screen here today our email addresses. Feel free to send us a message, an email to the email addresses. If there's anything you want to discuss, any questions or concerns or comments on the webinar, you're more than welcome to drop us an email. As normal, we will be recording this webinar and we'll send a copy of the webinar out to you along with the slides shortly after the broadcast. Now, just moving on to your presenters, hopefully you all know who I am and you've possibly seen me before. It's certainly not the first webinar I've done. It's certainly not the first webinar for schools and academies. Hopefully some of you joined us at our last webinar when I spoke about furloughing for schools, agency costs and all of those things you didn't have to do, reducing the financial burden sides. Well, today I'm joined by Louise Casey, who's head of our audit department, and she acts for a significant number of schools and academies herself. And between the two of us, we're going to take you through today's session. Hopefully you know who we are and our firm and our sort of credibilities when it comes to academies and acting as schools as such. I'm not going to labour on that point any further. We've got an awful lot to go through with you today, a jam-packed agenda for an hour. Hopefully will be an hour or just under. I'm going to take you through the first part of today's session, part one. As they say, I'm going to talk about the Academy Financial Handbook. That's going to lead us very nicely onto risk assessments, internal audit reviews, and changing auditors. I will then pass over to Louise, and Louise will take you through the Academy Accounts Direction, where we are with reducing the financial burdens, of all of those things start gearing back up again, all of those deferrals start to happen again as such, and that'll finish us off with a Q&A session. This is the first time that the handbook and the accounts direction have been issued sort of simultaneously within a week or two of each other, so we've got an awful lot to get through in this webinar and session. So let's get started. Changes this year to the Academy Financial Handbook. What I've done is I've tried to link the changes across certain sections, and I'm going to talk you through each individual section and link those sections to the changes. So the first section I'm going to mention is around governance and all the changes around governance. And on the whole here, this is to do with trustees and members. And the first item, the first change, I should say, is around trustees and trustees taking ownership of going concern. Now, I do often get a question over, Alex, what is going concern? And it is the ability for the trust to continue financially for the foreseeable future. And trustees now have a responsibility to take ownership of that going concern. And how do they do that? Well, they should be looking at the budgets and the forecasts for the trust to ensure that they are financially viable for them and their schools going forward. And I've put on the screen here a link to the government website because there is some specific guidance and best practices when it comes to trustees and how they should be assessing going concern for their schools. The second change on this section is to do with board meetings. Now, last year, there was an option for board meetings to be clerked. They should be clerked was the comment. Well, now this year we have a must. They must be clerked. Where I put an underline under the must, it means there is an obligation. You must do it. If you do not do it and your auditor spots it, it does mean there will be a regularity report issued within your financial statements, and that is reported to the ESFA, and then the ESFA contact you and find out what's gone on and ensure you don't do it again in the future as such. Equally, you will see there are lots of must nots where you shouldn't do things, and again, if you do those where you shouldn't, you'll get an equal regularity report, comment and statement. So I've got a must not now to do with members, and members must not be employed or hold any staff role within the trust. And that includes voluntary roles and unpaid roles. So they've clarified here that members must not be employed. So if you're still a trust that has a member and a trustee, and that trustee is, say, the head, well, unfortunately, that's a breach going forward, and you should not have that member sat on both, let alone be an employee if they're a member. There's a new regulation around members that they must be informed about trust business. How can members sort of assess trustees' responsibilities? How can that tiered approach work unless they know what is going on? Trustees have an obligation, members have an obligation to make sure trustees are performing their duties correctly as such. And we now have this new obligation for members to be informed about trust business to enable them to fulfill their duties as a member of the trust. So it's that differentiation between members, trustees and governance coming back here. Moving on to the next part. The next part, as you can probably guess, is all about the executive team. So when I say executive team, I mean the accounting officer, I mean the chief finance officer, I mean the chief executive officer. They're, in my opinion, the executive team. And we have a new requirement in relation to the CFO, the chief finance officer. Every single board and every single trust, regardless of size, must now appoint a CFO. It's as simple as that. That CFO can hold another role, so it can be the school business manager, it can be the finance director, but there now must be an appointment for a CFO. It must be in writing, and if you are appointed a CFO, there's an element of leadership and financial responsibility that goes with it. It's not just a title, but there is a new must when it comes to CFOs. In relation to CFOs as well, there must be a named individual, and that named individual should be an employee. Now, where that named individual is not an employee, ESFA prior approval is now required. So I know a lot of trusts that use third-party companies to help fulfill that role. So they come in and deal with the top-end financial side of things, and they act as CFO or accounting officer as such. It's going to be very difficult for those companies to do that because there needs to be a named employee, and you need that prior approval from the ESFA. I don't think those companies are going to stop doing their job. I just think there'll be a named employee by the trust using those companies to support them going forward, because the company itself can't act as that CFO or accounting officer. There has been a clarification in relation to the accounting officer within trusts. For a SAT, for a single academy trust, the department is expecting the accounting officer to be the principal, so the head teacher as such. For MATs, it expects the CEO to be the accounting officer, not the CFO. Common confusion going on there, so they're just clarifying expectations more than anything else. They have also said when it comes to CFOs that they must be appropriately qualified and experienced. And for the largest trusts amongst us, they must be fully qualified accountants. And they specifically mentioned all of the qualifications that you should consider when appointing CFOs. And I put them on the screen now. They're all the accounting qualifications that you can have. And they've also mentioned CPD for these individuals, that they should be maintaining CPD, very much like teachers should maintain CPD. And if you're a CFO on this webinar, then this counts as an hour's worth of CPD. Well, there's a requirement now to maintain CPD for the accounting officers and for the CFOs and CEOs going forward. Just moving on now into the next section, internal scrutiny is the next section. And this is probably the worst kept secret for the last 6 months. We've been talking about this section for 6 months, both internally with our schools and advising people. What am I talking about? I'm talking about the external auditor no longer being able to be the internal auditor as well. There is a new requirement that says internal function must be separate from external function. So if you currently have one auditor employed to do both roles, from September, that is not allowed. It stems from a piece of guidance for accountants that's been brought into the financial handbook here, hence we knew it was coming, and we sit on the forum for the ESFA as well, so they were going to incorporate it. So it's a big sort of shock for trusts possibly, but for a lot of us, we already knew it was going to come there. I'll be talking a little bit more about internal scrutiny and what your options are going forward. So if you still have an accountant that does both from September, you need to change how that is done. An interesting point when it comes to internal scrutiny is a lot of emphasis now being placed on the use of non-financial experts to provide assurance. So this is a financial handbook, but the stipulating here when it comes to internal scrutiny, you should not just be focusing on the financial side, you should also be focusing on the non-financial side and using relevant experts to provide assurance on the non-financial side of external scrutiny. Now, you all may remember from last year when it came to internal scrutiny, there was a requirement to submit your last internal report with your financial statements to the ESFA. That continues this year, so you still have to do that, but there now are must-haves when it comes to that report. I think what happened is there's a lot of trusts that use external auditors, and they're probably fine. There's a few trusts that probably did it internally, and they may not have ticked all the relevant boxes. So the ESFA have brought in a new requirement here that stipulates that there are 4 things you must do when it comes to this report. And this report must stipulate the areas that are being reviewed, what's being covered as such, the key findings of the work that was undertaken, the recommendations that are being proposed, and the conclusions of the report. And that declaration must be made with the accounts and the report sent over to the ESFA every single year by the end of December, but in reality, that's before you break for Christmas. Moving on to the next section, we're going on to general controls and transparency here. And the first item I've got listed is fixed asset registers. There's a new must-have to maintain fixed asset registers. I read that and I thought, well, I'd be surprised if any trust didn't have a fixed asset register, to be honest with you. But it goes beyond that, to be honest, because fixed asset registers are probably far more complicated than you may think. You may think of them as a list of all of the assets the trust has, but it does go beyond that. From an accounting perspective, your fixed asset register should not only show the asset, but lots more things as well. And I'll give an example here. Let's just say a trust was buying computers and it was spending £10,000 on updating its computers. And it was going to use some money from its DFC, from its devolved form of capita, and maybe some money from GAG as such. Well, not only do those assets need to be shown on the fixed asset register, those computers, but how they've been bought, whether the money was used from DFC or from GAG, should be attached to every single one of those assets. And then that asset is then depreciated each year. That depreciation follows how it was bought. So you can actually see why fixed asset registers are a little bit more complicated than when you first think and you first read these things and say, of course, we've got a fixed asset register. We list all of our assets. Well, it may not be sufficient going forward. The next item I have on my list is termly reviews of pupil projections and trustees challenging the basis for pupil projections going forward. Now, I read this and thought, okay, give me an example, Alex, over what they mean here. I think the most obvious one is the impact of an Ofsted inspection. If you've got a school that's possibly outstanding or good, and maybe they are inspected and they drop a category or two, there is often an impact on pupil numbers, and that leads to an impact on the financial side of things. Well, now you have a requirement to review pupil projections going forward on a termly basis and updating the budget and forecasts as a result to compensate for any loss of pupils or increase in pupils if it's going the other way. The next item on this section is an encouragement for the use of the integrated approach to curriculum financial planning. I always struggle to say that, the ICFP, and the 7-step guide that goes with it. Now, the ICFP is nothing new. It's been going on for quite a number of years. And if you did do it sort of 2-3 years ago, there was actually some funding available for you to integrate curriculum and financial planning. You got paid to do it as such. Well, now there's a new encouragement for you to sort of do this. I describe the ICFP as a combination of your school development plan and maybe the sort of report that you do for pupil premium, putting them together, applying them across the whole of the school and the trust, and that's sort of an element of ICFP, where they're saying you should be doing it, and they're publishing specific guidance on ICFP and the 7 steps. I have put them on the slide, they're on the screen. You can have a look and download them at your leisure a little bit later on. Moving on and continuing with the general controls and transparency as such, you may guess what's coming next based on the picture on the slides here. Well, I'm going to be talking about schools' resource self-assessment. There is a requirement for each school, each trust rather, to submit their school resource self-assessment annually. It's still not being done by an awful lot of trusts. Well, now you have an obligation to do so. You must complete it. You must submit it to the ESFA on an annual basis. The deadline's usually mid-November. It changes ever so slightly each year. And it just rates some of your costs using the table on the right-hand side. I appreciate you can't see the details behind there, but now we have a must requirement. You are obligated to do so. I don't think it's one of those items that's included in the name and shame list, but it possibly will be going forward if you certainly don't do it. And if you don't do it and your auditor spots it, then obviously you've got a regularity report issue. The next one raised an eyebrow and made me chuckle because it's around alcohol. And it says trust funds must not use funds to purchase alcohol for consumption. Now, I read that thinking, oh, wonderful. You can still bribe your auditors by buying them a bottle of wine if you wish to do so. You just can't drink it yourself. The clarification isn't about that. The clarification is it can be used in religious services rather than anything else. I often get asked about what about staff parties. Well, if you're buying alcohol in staff parties, technically it's a breach, I'm afraid. It's horrible to say, but it's there in black and white. You should not be purchasing alcohol for consumption. It's as simple as that, I'm afraid. On to risk registers. Risk registers must be maintained by a trust. It's as simple as that. I've got an agenda item a little bit later on, so I'm not going to dwell on that point any further than that. And the next item is audit and risk committees, or your associated committee if you don't have a dedicated one. And there's a whole host of changes around this area. And you can have a read of it yourself, because I think it'll raise an eyebrow and bring a chuckle to you when it comes to looking at this. Everything from reviewing how the auditors plan their audits to how the auditors use technology to audit your school and your trust. Have a look at page 35, 4.17, because you have an obligation to do this now. Never mind the auditors having the obligation. The auditor has to tell you how it's done. You have an obligation to ask and to review and ensure you're happy with it. So have a look at page 35, 4.17 there to make sure you know what you should be doing on your committees going forward from September. On to website publications. A couple of changes when it comes to website publications here. And the first thing to note is higher paid employees. Now, the DfE have been banging their drum for quite a significant amount of time when it comes to higher paid employees and how they just don't like anybody being paid more than £100,000. It's as simple as that. They've issued letters left, right and centre to chair of governors, to executive officers, to accounting officers. It's as simple as that, saying you really shouldn't be paying people these sums of money and you have to justify it if you do. Well, now we have a new obligation that says if you do, you must disclose it on your website. In other words, if you have somebody that's paid in excess of £100,000, excluding the pension contribution here, then you must show the number of employees there in £10,000 banding. So in other words, if I was on a salary of £105,000, you might say between 100 and 110, there is one employee being me because I'm paid £105,000. That has to be shown on your website going forward. The next item here was a bit of an eyebrow raiser because I'd be surprised if you've not already got it on your website for compliance purposes, but it's there in the handbook now. It wasn't before. Whistleblowing policy must be shown on the Trust website. I'm sure you've probably already got it there, but if you haven't got it there, you now have a financial handbook obligation for it to be included on the website. All of this is included within the handbook itself, and I've put a link to the handbook on the slides, but hopefully that gives you an overall summary and picture of the changes within the handbook. Quite a lot to consider, quite a lot to review. We've got to September just to make sure that you're ticking off all of those and you're happy with all of that. Okay, just moving on to the next section. I did say it was going to be very speedy today to try and speed everything and sort of bring everything into today's webinar. This section is around risk registers. I'm going to talk about the requirements per the financial handbook and everything that you should be doing in relation to risk registers. Now, trusts have an obligation to ensure effective operation and management of risks. That obligation is on the trustees. So the trustees must ensure it's happening, and they must review that risk register at least annually. I love the word at least. There's a minimum requirement for annually, but what's the point in adding the at least? You either tell us to do it annually or more frequently, really. But we know that you've got a minimum requirement to review that risk register on an annual basis, and it must cover all operations and activities of the trust, not just financial. I suppose one of the relevant ones at the moment would be the huge risk around COVID-19 and the impact it would have on your school. If, say, a pupil or a teacher got, what's the impact, what's the assessment, what would you have to do if that happened? That's not a financial risk, but it's a risk, and it should be on your risk register, and it should play a massive part of your risk register, both at the moment and going forward. Now, you must establish an audit and risk committee. It doesn't have to be named that. For the larger trusts amongst us, then you have to have a dedicated audit and risk committee. It should be named that. For the smaller trusts, then actually you can combine it with another committee, with a finance committee or whatever committees you have. But it should do the same things as an audit and risk committee. And it should meet at least 3 times a year. And if you don't do that, again, it's a non-compliance with the handbook. Now, that committee itself, it must ensure that risks are reviewed and addressed, and it must report the management of risks back to the Board of Trustees, because they have that overall responsibility. It's their responsibility to ensure that risks are managed as such. So there is an obligation for the committee to report upwards to the trustees. Now, risk assessments and risk reviews are huge amounts of work. I can't stress the amount of work that goes into reviewing risks and putting all of these documents together. But how do you do it? How do you do it as such? Well, the first thing you've got to do is have a policy. If you've not got a policy on risk, you need to have a policy setting out the aims, the objectives, the trust's approach to risk, how you're going to deal with it. That leads nicely onto a strategy, how you're going to identify and assess the risks. And then it leads on to the management as such, the impact of risks, the reduction, the mitigation, the transferring, the acceptance. And once you've done all of that, you come to the risk register, which is the obligation that you have to maintain and update a risk register. That's a huge amount of work for normally a lot of people to do, to be honest with you. Thankfully, there's quite a bit out there to help you sort of with that work. I always refer to the Institute of School Business Leaderships. Why? Because it's such a great website, to be honest, and there's so much information contained on it, and all of it is free to download. They've got pro formas and examples of virtually every document I think you will possibly need, including ones on risk. So you'll see I put an example on the left-hand side where they've reviewed risk. I think this one is health and safety. I've just cherry-picked one. They've rated it medium and lower, such color-coded. And what they've got on there as an example, risk register. This one is obviously blank, and what would happen is that document on the left would filter onto the risk register on the right, and the risk register would be compiled and presented to the Board of Trustees, and your auditors should be ensuring that you have that risk register, it's reviewed and maintained. If you're not doing that, then you're going to be spending an awful lot of time getting it updated and in place going forward. That's risk management. Onto internal audits and what are the options, the next section. So as always, let's just clarify on what the requirements and the purpose of the internal audits are. Well, trusts have an obligation, they have a must-have requirement when it comes to internal scrutiny. You have to have internal scrutiny, you have to provide independent assurance to the board on its financial and, I'm going to emphasize it again, non-financial controls within the trust and ensure that they are operating effectively and efficiently. Now, it cannot be performed by the trust's own accounting officer, CFO, or other members of the finance team. It cannot, it must not be doing so. If you do so going forward, it will be a breach. So where people did read that peer reviews was allowed, you cannot do it now. It's as simple as that, really. It cannot be performed by your own finance team as such. Who can do it? Well, whoever does it must be suitably qualified and experienced. That's a requirement now. And what work they do must be directed, agreed, and assessed by the committee I spoke about before, the audit, the risk committee, or whatever committee you have in place. They're the ones that should be directing what work is done and agreeing it in advance with whoever you decide that will undertake the internal scrutiny. When it comes to the new options, you've technically got 4 options going forward. The first option is to employ an in-house auditor. I think that one's very costly. I can't see many trusts doing that unless you're a very large trust and it becomes their job and their role. It's certainly not a full-time role, it's certainly not a part-time role, to be honest with you. I think that will not be the norm. I think there'll be very few people who actually are employing in-house auditors. The second option is to buy in internal audit firms. In other words, have 2 different accountants, one accountant doing your external audit, one accountant doing your internal audit. But I wish to emphasize again the mention of non-financial assurance. An accountant is there to give you financial assurance. So it could be actually you have many firms or 1 or 2 firms that provide you with internal assurance going forward. It might be that you have an accountant doing internal reviews on one term, and then you have a different company coming in looking at non-financial assurance at a different time in the term, or a different term as sort of such. So that's the sort of second option, is buy-in services. The third option is to appoint a non-employed trustee. So the ideal scenario here is you've got an accountant that's on the Board of Trustees and they are suitably qualified and experienced, then they can undertake the work. They are not part of the finance team, they're separate from it, so that is allowed. And then the fourth option is a peer review by a CFO from a different trust, so where you may cross-reference the services between 2 different trusts. The bottom 2 obviously have the benefit of not costing you any money, but they do have lots of drawbacks as well, in the sense of experience and independence, especially if you've got CFOs cross-referencing to each other. Are they really going to want to talk negatively or raise some challenging questions, knowing that that CFO is going to come in and assess them? The top one certainly doesn't provide independence if we're talking about employing in-house. And then the middle one's going to cost you a bit of money, the bought-in services. you as trusts need to decide on which is right for you and your trust, really, when it comes here. But what you can't do going forward is use your external auditor as your internal auditor, which did historically bring some economies of scale into it. As such, it's just not possible going forward. Okay, moving on to change of auditors. Now, I put this on as an agenda item because I often get asked a lot of questions in relation to changing of auditors. Normally when trusts are coming to me, hopefully not the other way around as such. So I just thought I would just mention the process, because not many people realise what the process is. It's a common question, to be honest, and some of the issues we find when taking on clients as well. And in relation to the appointment, you should have separate engagement letters. This is a requirement within the handbook as such. Separate engagement letters should be covering the audit on one side and then all of the other services on the other side. Often you find, and best practices actually have 3 letters. One is the audit, one might be the accounts and the accounts return, and the other one is the end of year certificate. That's quite normal, but if you've just got one engagement letter covering everything, I'm afraid that's not allowed. It's a breach of the handbook and the auditors shouldn't be doing it. Equally, the engagement letter should and must allow for the removal of change of auditors at any point. I often see trusts and hear trusts saying, I'm tied in for 2 years, don't really like my auditors, but I've got 2 years left, or I've got 5 years left with them. Well, I'm afraid if they're tying you in, they're in breach because they're not allowed to. The handbook clearly states that engagement letters must allow for the change of auditors at any time and point if you choose to do so. What do you do if you do change auditors? Well, there's a couple of things you must do going forward. You must notify the ESFA with the reason for changing auditors. It may just be you've gone out to tender. It's as simple as that. If there is a resignation, so if your auditors resign for some reason, maybe they just decided not to audit schools anymore, or there's been a fallout or something, then a copy of the letter is required, and that has to be submitted to the ESFA as well. I'm often asked when is the best time to change auditors, and the answer is there is no best time or worst time. You can change auditors as and when you wish as such. There's a few things you need to be aware of. As such, there's no technical minimum or maximum term of office for an accountant or an auditor. They do have to do certain things if they've been in post for 10 years. Interesting thing here I've raised is switching frequently is just as bad as not switching at all or not reviewing in a lengthy period. I often hear about trusts switching every 2 to 3 years. It does bring some benefits. The question is, with those academies that do that, or some trusts that do that, will it take 1 to 2 years for your auditor to learn your processes, your procedures, to document and to know what's going on? So you've only had 1 good year of your auditor, one sort of best value, proactive service of your auditor, and then you're changing again. Oh dear, that's a negative scenario. Yes, there are other positive scenarios as well. Best value for money, obviously, is always a consideration with these things. How do you do it? It's not complicated. There should be full tenders criteria over how you're assessing someone's needs. And the big one when it comes to the sector is the sector experience and expertise. I can't emphasize that enough. There are lots of accountants out there that deal with schools and academies. That's brilliant. There are lots that do not have the experience and expertise. It's a unique sector. The amount of times I hear, oh, they're just a charity. No, they're not. The special rules and regulations, it's a complicated set of accounts with complicated rules and regulations. Always ensure you've got sufficient expertise and experience when you go out to tender and have a look and consider changing and appointing new auditors. Now then, that's me done. I'm going to bring in Louise now. Louise is going to join us and take us through the next part of today's session. Hello, Louise.
Hello, thank you very much, Alex. Hi, everyone.
I'm going to leave you to it. I will join you back at the end for the Q&A. You've probably had enough of my voice. I will leave you now to Louise. Louise, all yours.
Thank you very much, Alex. Hi, everyone. So as Alex has highlighted, I am going to take the second part of today's webinar, starting with a look over the changes in the Academy's accounts direction, and then just having a look at some of the financial burden relief that the ESFA have implemented, both from a financial assistance point of view and also and operational deferral of returns. So let's start with the accounts direction then. So Alex has already discussed the changes to the Academy's financial handbook, and as he said, this is the first time that the two have come in hand by hand. So the Academy's accounts direction was released just a couple of weeks ago. It's now a hefty 169 pages for those of you that have had a look at it. And this is actually without any of the COVID-related guidance that we are anticipating from the ESFA. I sit on the Auditors Forum within the ESFA, and we did have notification yesterday that the guidance is in hand and they are looking to issue that document imminently. So the Academy's accounts direction, it's going to be relevant for Academy Trust for the year ended 31st of August 2020. So it includes a number of new disclosures, but also clarifying some of the guidance around areas such as going concern, regularity and governance. What's really important to note though is that there's actually no changes in the underlying accounting principles. So this is looking at the FRS 102 and the SORP that the Academy's accounts are prepared under. However, it is important to highlight that some of the changes that we're going to go through today are reflective of the change to SORP 19. And again, these are effective for years starting on or after January 2019. So there are some specific Academy sector changes, and we'll also run through those. Just as a preemptive, some of these changes that we're going to run through today are only applicable to large companies. So they're Academy trusts that fall within the following criteria. So this is meeting 2 of being turnover of more than 36 million, gross assets of more than 18 million, and more than 250 employees. So that's meeting any 2 of those criteria, you'd be classified as large under Companies Act criteria. So when we look at the next slide, it's really important to note that these are all changes that are only applicable for large companies, and they centre around the trustees report. And this is bringing the trustees report in line with the Companies Act strategic report requirements for those large companies. So the first point to make is around the report now needing to include disclosures around employee engagement. So this is if you have more than 250 employees, which I know some of you on this webinar do indeed have. So these disclosures include how the trust has regard for employee interests, how it has impacted decision making during the year, how employees are engaged and encouraged to be involved with the trust performance, and how employees are provided with information to allow them to do their job, details of the trust policies, and training and development and promotion issues. So this is an enhanced disclosure, and within the accounts direction, there is the example accounts, the Coketown accounts, and it does give some guidance in relation to what they're expecting to be included in this regard. The second change, again for large companies, is around disclosure around suppliers, customers and other business relationships. So this is looking at the community, beneficiaries and funders, and disclosures in this respect should include how they have considered the relationships and how they have impacted decision making that the trust has made within the year. Okay, so the next one is what I would perceive as being the largest change, and it is going to need some thought and preparation before the year end in order to meet. So this is referring back to section 172 of the Companies Act, and it's all around the promotion of the success of the company in this respect, the Academy Trust. So these are new regulations which apply in relation to the trustees, and whether they have complied with their legal duty as set out in the Section 172 of the Companies Act, and how they are working to promote the success of the Academy Trust. So there's some specifics that need to be included, and without quoting exactly, it's around the director of the company must acting in a way that he or she considers in good faith would be most likely to promote the success of the company. So these, for example, are the interests of the company's employees, consequences of decision making, impact on the company's operations, on both the community and the environment, and the need to act fairly as members of the company. So now there is a requirement to include a statement in the report describing how the trustees have had regard for the above matters, and likewise in Coketown there is some further guidance and examples of the sort of information that needs to be provided within that statement. Okay, so we've also got quite a big change in relation to the streamlined energy and carbon reporting requirements. So again, only relating to large trusts, and those trusts that consume more than 40,000 kilowatts of energy in any reporting period, they must now include statistics on energy use, including annual use, emissions, intensity ratios, and also some narrative around the energy measures taken to improve efficiency. As an added requirement, the ESFA have now also said that they are encouraging the relevant trusts to publish this information on their website. So the above disclosures align the trusts in with those of large companies, and as I've mentioned, are applicable for periods commencing on or after the 1st of January 2019. Therefore, they are applicable for our 31st of August 2020 year ends. I have included a link within this slide, which gives you a link to the Academy Trust Financial Management Good Practice Guide, and this is around the streamlined energy and carbon reporting requirements, and it's quite a useful document that highlights some of the considerations that you as Academy Trust need to have in order to provide that disclosure information within the trustees report. Okay, so we'll have a look now at some of the other changes that have come in, and this is applicable to all trusts no matter what size. So the first one is around the government statement, and now there is just a requirement that trusts must explicitly refer to the guidance in the governance handbook and competency framework, where trustees have reviewed and taken account of these publications. So what that means is you are now required to explicitly state the actions you've taken and what you have taken from review of those documents. Secondly, we're also required now to look at the risk management disclosures, and these are required to include a further description of the internal scrutiny function, which Alex has been through, and also describe how these arrangements have been impacted by the revised ethical standard for auditors, and what measures have been taken by Academy Trust in the provision relating to auditor independence, including those internal audit matters that Alex has been through. So now for the really dry element of all of this, looking at the accounting disclosures. Now, I think most people will be pleased to note that actually the changes in the accounting disclosures that have been introduced via this 2020 accounts direction is quite minimal and isn't overly onerous. But we will go through what changes have occurred. So firstly, legal costs. Legal costs now should be clearly identified and disclosed within the notes to the financial statements. So we are going to need that to be separately prepared and disclosed, still within support costs, but on its own line. So as part of our audit work, we will be looking to collate those and ensure that they are fairly stated. Second change in relation to the accounting disclosures is around the analysis of a net debt note. Now, many of you will probably say net debt, well, academies shouldn't have any debt. But this is actually a requirement that's been brought in to comply with the SORP 19. So this net debt reconciliation discloses any movements in borrowings. So this is anything such as Salix loans or any agreed borrowings from the ESFA, less the cash and cash equivalents. Okay. Another change that's come in is actually relating to GAG pooling and looking at the reserves of charities, of the academies. So where multi-academy trusts have some academies with nil balance funds at year end, whether that's for the current year and the comparative year, there needs to be some narrative to explain why no balances are shown within this note. Looking slightly at some more technical side of the accounts, and this is where subsidiary entities are deemed to be immaterial or the results are not consolidated within the Academy Trust's results. So the accounts direction now clarifies that where there are 2 or more subsidiaries, then their materiality should be considered collectively. So if any of you do have subsidiaries where historically they have not been consolidated, it's just ensuring that an annual review of the materiality levels is taken into account and that any subsidiaries where there's more than one, they're looked at collectively and the materiality impact is looked at collectively. And then finally, just on the accounts disclosure point of view, as expected, there is a revised teachers' pension disclosures note to reflect the latest actuarial valuations and contribution rates. So this should be included within the notes of the accounts, and I think most of you will work with your auditors in getting those notes completed. Okay, so we'll have a look now at some of the regularity changes and what the accounts direction means for the regulatory report. So the first change here is around the accounting officer and the reporting accountant's opinion on regularity, and if there is a deviation, so if they have identified any instance of irregularity or non-compliance, these are obviously noted within both the accounting officer's statement and reporting accountant's report. Now, the case in being now is that we are required, where possible, to quantify the amounts involved and disclose those within those reports. Second change here is just emphasising the accounting officer's responsibilities, especially if an accounting officer leaves during the year or partway through the year. And the responsibility of the new accounting officer, ensuring that they are fully up to speed with what's happened in the year, what the previous accounting officer has done, and feeling comfortable that they can sign off their statement knowing everything that has gone on within that year. So a few ways in which this can be achieved. So through evidence of discussions between the new accounting officer and trustees, the internal auditor reports and understanding of those, discussions with the senior leadership team, and where possible, the previous accounting officer. In most cases, you would hope that there'd be a nice handover, so that was a pretty seamless experience. It's also really important that they're looking at copies of relevant minutes and reports during the period covered by the statement, so that they feel confident in putting their signature to that report. I'm going to touch upon going concern, mainly because whilst there's been no significant changes in this area, the accounts direction does continue to include quite detailed guidance on going concern and some general disclosures, including reference to any material uncertainties. So probably more relevant if there are academies on financial notice to improve, those who are struggling at the moment with any COVID-related instances. And I really want to highlight here that the ESFA have actually published some very specific guidance around going concern. And this is entitled Operating an Academy Trust as a Going Concern. So this is signposted in the accounts direction and sets out steps in which trustees may take in forming their going concern conclusions. Okay, so as I've mentioned, we are anticipating imminently some further guidance around COVID, and we will communicate that with you once it arrives. So I think what's really crucial is actually looking at what does the change in the Academy's financial handbook, what does the change in the accounts direction actually mean, and how you can prepare for that before the audit cycle commences. So we do recognise that you're going to be very challenged both operationally and also with personnel working from home. So it's really important that you give due consideration to some of these changes, particularly if you are a large trust and those specific large company requirements that have come in. So preparation obviously is key, and opening dialogue nice and early to talk through any concerns you have about any of the changes, and making sure that it's opened up so that there's a good communication from this point before all the accounts and audit is commenced. So the accounts direction does make reference to the ESFA's good practice checklist. Now, this is an 8-page document which is really detailed and gives you a nice checklist of how you can prepare for the external audit to get the best both out of the audit process and also to make sure that you've collated everything nice and early within that process to meet the completion deadlines. So I'm conscious of time here, so I'm just going to quickly go through some of the financial burden issues that have arisen and how the ESFA has helped with those. So since Alex's earlier webinar, earlier last month, there has been some of the reports that have now been restarted. So there is a list there and also a really useful link as to where things are up to from a deferral, cancellation and restarting point of view. Now, there is one item on this agenda that I'm going to go through in a bit more detail, which is the budget forecast return. But if you do follow that link, there is some useful information on there. So we'll also have a look at what is being deferred. So still cancelled is the school summer census and Key Stage 2 teacher assessments. But since Alex's webinar, there has been a further review of some of the items up to the 30th of June. And until at least the 30th of September, there has been some further deferrals, specifically the financial management governance self-assessment and some of the capital grant return requirements. Again, another link to the same document, just so that you can keep up to date with what has been deferred or cancelled. So if we have a look now at the BFR 3-year, just want to highlight some of the most significant advances in this. Yes, it has been brought back in. It is no longer cancelled. However, what they have done is extended the deadline to the 29th of September, giving an extra couple of months. Now, I know for most trusts, they'll be quite keen to get this in before they start the audit process. So I'd probably suggest if there is any assistance needed with these returns, it's looked to be done within August so that it can be done nice and early in the cycle. So there are a couple of changes to this BFR return. One in that there will not be a requirement to complete 3 years. They're actually only looking to take it to 2021 budget. So that will be outturn for 1920 and the budget for 2021. However, what they have included now is a section that analyses income and expenditure in a bit more detail. And this is so that they can get a feel for the impact of COVID-19 on schools and their resources. So that is a new requirement this year. They've also asked if within the additional detail section within the preparer and approver declarations that any additional information in relation to the challenges that the Academy has faced are entered into there, just so that they get a real feel for how schools have been burdened by COVID. So it's obviously really important to highlight that with financial forecasting, it does involve a degree of volatility and uncertainty, and you will need to review the Academy's position. And it's also really important to note that just because the requirement is no longer to include those 3-year forecasts, it's important that, and in line with the Academy's financial handbook, trusts are still looking at a longer period of forecasts so they can fully understand what's happening with pupil numbers, what's happening to key variables, planning out and mapping out future income and expenditure to make sure that their individual circumstances, strategic aims and approach to financial planning is maintained. So BFR is back on, extended deadline, bit more information on past results, how it's been impacted by COVID, but a reduction in the requirement to look at a 3-year plan. Important just also to notice that there has been no deferral or cancellation of the teacher pension returns. So these were due the 29th of May, nor for the audited end of year certificates, which are due by the 30th of September. I think this in essence means that your auditor should really be liaising with you now to ensure that these are completed in July and August before the audit cycle continues. And just to quickly look at the final slide of the presentation. So this is just emphasising in relation to the exceptional costs and the grant that the ESFA are providing. The deadline is the 29th of July to submit the application. There will be no opportunity past that to resubmit. However, I do believe that in the autumn they are going to look to make an additional grant available, so you may be able to apply at a later stage. I've highlighted some of the items that you can and can't claim for. I'm sure most of you will be very familiar with these points, and I'm welcome to field any questions in relation to that, but I've just highlighted some of the key, what you can and what you can't claim for there. Conscious of time, so if I can invite Alex back to join me, we will look to open up to a question and answers. Okay, hello. Hi Alex.
Hello, thank you for that. Very interesting and entertaining. I've got a couple of questions from my session, conscious that we're nearly at the end, so I'll just take two. One of them is quite interesting, and the other one's, well, both very interesting, to be honest with you. So the first one that's come to me is said that we currently use our external auditors to perform our responsible officer visits terminally, and they report back to our internal control committee on a monthly basis as such. Do we need to change that process? And the answer is yes, most certainly. Your external auditors cannot be your internal auditors going forward. They're not allowed to do both jobs effectively. So you need to decide on, do you wish to change your internal auditors or do you wish to change your external auditors? They cannot be the same person, the same firm from September. The second question I've got asked is around a MAT. And the MAT here said, what about peer reviews from CFOs or equivalents at different schools, but part of the same multi-academy trust? And I'm afraid that's still part of the same financial team and financial function of the MAT. There is no independence there. Whilst you might argue there's certainly independence within schools, you don't have the independence on a MAT side. And as a result, no, it's reading the handbook, that is not allowed. You cannot do that going forward. You must use an external person in this regard. So sadly not. So they're the two main questions I'm going to ask, or I'm going to answer rather, that have come through. Louise, were there any your end that you wanted to discuss?
Just one my end, and that was just in relation to the budget return, and obviously in relation to schools being a bit disrupted at this period of the year, and therefore some of the costs that would usually fall into this year actually not going to fall into this year, will fall into next year, and how that in turn translate to a carried forward of GAG this year for utilisation next year, and the way that that's perceived. So I think in this case, obviously, you can only recognise costs in the period to which they relate. So if you are not contractually obliged or entered into a contract to make purchases in this current year, but will be looking to do so come September, then you will have to recognise that expenditure next year. So what this means is that potentially this year you are going to recognise a larger surplus, with those funds then being carried forward within your funds balances and used next year. So I think important point to make in that unless there is that contractual obligation, then costs need to fall where they are due.
Brilliant. Well, I think we've just slightly overrun on the session, so we'll probably leave it there unless there's anything pressing that you wanted to mention, Louise.
No, I think that's all from me.
Thank you all for attending. I hope you found that interesting. If you've got any questions or you've asked a question and we haven't yet answered it, we will come back to you via email shortly after the session here today. Have a lovely afternoon and hopefully we'll see you all soon. Take care. Bye.
Bye.